Welcome to Cotality's Housing Market Update for June 2025, brought to you by onthehouse.com.au. Australian dwelling values rose another 0.5% in May, taking the national index 1.7% higher over the first 5 months of the year. Capital gains were recorded across all the capital cities, led by Darwin at 1.6%, with all others posting a monthly rise of at least 0.4%. The May update marks the fourth consecutive month of growth, following a short and shallow decline of 0.4% over the 3 months ending January 2025. The continued momentum we're seeing across almost all markets is no doubt being fueled by rate cuts and a widespread expectation that interest rates will fall further through the year. With the most recent cut in May, we're likely to see a positive influence flow through to housing values in June and the remainder of the year. The week after May's interest rate cut saw the capital city auction clearance rate rise to 65.1%. That's the highest clearance rate since July of last year. Despite some monthly momentum forming, the pace of annual growth in the National Home Value Index slowed to 3.3%. That's the weakest 12-month change since the year ending August 2023. The slower annual pace of growth reflects the easing in capital gains through the second half of the year, culminating in the modest fall in values over the 3 months to January. Only Melbourne and Canberra have recorded an annual decline in housing values, demonstrating the resilience of the market through a period of relatively high interest rates and cost of living pressures. Alongside the broad-based rise in housing values, the capital city trends have shown a clear convergence. The range between the highest and the lowest annual change in dwelling values at 9.8 percentage points hasn't been this narrow since March of 2021. The convergence in capital city growth rates comes shortly after the most diverse housing conditions since 2007. The rise in housing values continues to be led by lower price points across most cities. However, the growth rates across different price points are also coming together as the more expensive end of the market starts to accelerate off the back of rate cuts. Regional markets are also showing a positive trend, with each of the rest of state markets recording a rise in values through the year to date. The strongest gains have been in regional South Australia, where values are up 5.8% over the first 5 months of 2025. At the other end of the spectrum is regional Tasmanian values, which have held reasonably flat over the same period, up just 0.1%. The macro trend in rental markets is one of slowing growth, albeit with some seasonality providing a positive influence on trends through the earlier months of the year. The monthly pace of rental growth eased back to 0.4% in May, following 3 months of 0.6% month-on-month gains. Focusing on the annual trend in rents helps to cut through the seasonality, showing a clear slowdown in the pace of growth across most cities, although there are a few exceptions, like Darwin and Hobart, where rental growth is accelerated. The largest capital cities of Sydney and Melbourne are now among the softest rental markets in the country, following a period of extreme rental growth. Slower rental growth, despite persistently tight vacancy rates, comes down to a combination of affordability constraints and normalizing net overseas migration. Even if there are few vacant properties available for rent, it's hard to see how rental values can continue to record a strong rise of already high prices. As in many advanced economies, net overseas migration has been slowing as the period of COVID catch-up migration moves to an end following border closures and recent temporary migrant departures. Because most overseas arrivals rent, this is contributing to the slowdown in rental demand. Sydney dwelling values moved through a fourth consecutive month of growth in May, with values up 0.5% over the month to be 1.3% higher through the year to date. Although the market is once again showing a consistent uptrend, values remain slightly below their all-time highs, down 0.3%, following a 1.9% drop in values over the 4 months to January. So far this year, the growth trend has favoured houses over units, with values up 1.7% over the first 5 months of the year, compared with a flat result for unit values over the same period. Looking forward, the RBA is becoming more comfortable with the path of inflation, supporting a widespread expectation that interest rates are set to reduce further. Given the close relationship between interest rates and housing markets, there's likely to be further upside for the volume of home sales and prices. Some renewed confidence in decision-making after the federal election and an ongoing undersupply of newly built homes are other factors that are likely to support further price growth. The RBA expects core inflation will be around the middle of the 2 to 3% target range by June of this year, holding there until at least mid-2027. Confidence that inflation will remain within the target range is crucial for interest rates to reduce further. Adding to the argument for further rate cuts is the expectation that labour markets will gradually loosen through the year, with the RBA forecasting the unemployment rate to rise to 4.3% by year's end. A relatively soft upwards trajectory in GDP growth, forecast to reach 2.1% for the 2025 calendar year, is another factor supporting a lower cash rate. Alongside lower interest rates and lower inflation, it's reasonable to expect a further rise in sentiment, albeit with offsetting factors like global uncertainty amid tariff talks and conflicts that are likely to temper any substantial rise in sentiment. Some renewed political certainty following Labor Party's federal election win is another positive for housing decision-making. A pillar of the party's election platform was a first homebuyer initiative providing access to home ownership with government-backed deposit guarantees. While the expanded 5% deposit guarantee doesn't go live until next year, we could see financially capable first homebuyers looking to beat the rush in 2025. There's also downside factors that will probably keep any material upswing in housing values in check. Affordability pressures, which are also evident across most housing markets, are also set to constrain housing demand to some extent. At the end of last year, the national dwelling value to household income ratio was on par with record levels at 8.0, while home loan serviceability was also at an all-time high. Lending policies and regulations are another factor that could keep a lid on housing exuberance. Since 2023, borrowers with a debt-to-income ratio of 6 times or higher have comprised around 6% or less of new home loan originations. Any sign of higher housing-related debt levels could be met with a tighter policy framework for home lending. Lower population growth should also help to quell the accrual of housing demand in the absence of a supply response. Overall, we're still expecting housing values to post a modest rise in 2025, albeit at a slower pace than what we saw through 2024. As always, you can keep up to date with the ebbs and flows of property trends at the news and research pages of our website, where you'll soon see our domain change to cotality.com.au.